So, and excuse me if I kind of look off a little bit because I'm letting other people in as well. So, how much could buying a home in this market really cost you? So I did this because we're getting lots of questions about interest rates, about appraisal gap, about I see this rate over here, but you're showing me this rate. So we are getting a lot of those kind of questions, and rightly so. Interest rates have increased the fastest that they've ever increased in 43 years. I've done this business for 22 years. It is definitely the fastest I've ever seen interest rates move up. So it is humbling and uncertain for everyone, including myself. And I've definitely seen interest rates higher than this. We've definitely done mortgages with interest rates higher than this, but it's been a while, and the speed of which they have gone up is unprecedented. So I understand why a lot of people are asking some of these questions. So let's get started. What I wanted to go through basically was just to start, and we'll kind of go over it because I want to make sure if you guys have questions, definitely just unmute yourself or put it in the chat. But closing costs, what is normal, what is not, and how can they vary? So one thing that you always want to pay attention to are, when you're looking at any closing costs, third-party fees. Third-party fees are basically these two sections of fees that every lender is going to have and charge, and you really don't have any control over them. Meaning an appraisal gives us an invoice and that's how much it is. A title company gives us an invoice and that's how much it is. Regardless of the lender that you're working with, these items will be an invoice and we don't have any control over them, and they should pretty much be the same no matter where you go. Okay, so title company fees, recording fees, and mortgage registration tax, all fees we have no control over. Appraisal, again, we do have some control based on who we use, but in general, we get an invoice and that's what it is. Credit report. Some people will ask me about credit reports because I feel like ours, maybe there might be cheaper ones out there. But what's most important for us during for the credit report is that once you go under contract, we actually monitor your credit all the way through closing. The reason that we do that is because that's when your credit is the most exposed. Title companies have your date of birth and social, your insurance company. There are a lot of people that are touching private information. So as a service to you, we actually monitor your credit, because that way, if we see any inquiries or anything, we're going to get alerted ASAP. It's for your benefit and for ours. And then flood certification to make sure you're not in a flood zone. So those are third-party fees that really everyone has, and nobody really has a whole lot of control. So when people are looking at fees, lender fees, this section is really where they want to focus. And in general, these are the areas where we've got some flexibility. So we have an underwriting fee. Sometimes they're going to be called a commitment fee. Sometimes they're going to be called doc prep. I mean, there's lots of different things. Every company usually will charge a chunk of money to help cover underwriters, automated systems, fraud checks, those kind of things. That's what those fees are going from. These fees can range anywhere from $600 to $1,500. It just depends. Okay. So we all have something. It's just what we call it might be a little bit different. Prepaid items. So this is my biggest challenge sometimes when people look at stuff and they're like, oh, your fees were a little bit more expensive. Well, prepaid items, we're estimating taxes, insurance, mortgage insurance, and those things are things that we're estimating. And so I may estimate homeowners insurance to be X, but maybe my friend down the street X estimates it to be Y, and maybe there's a $600 difference in what we're estimating. At the end of the day, that's going to make your monthly payment look lower. That's going to make your cash to close look lower. So sometimes this category, because they're estimated, can cause people some challenges because some people estimate low. I will estimate very consistently. I have a chart for homeowners insurance that I use based on the property value, and I use 1.25% of the home's value to estimate taxes. and 1.5% of the home's value if you are in the city of Minneapolis or St. Paul. So I'm very consistent with how I show and estimate those. And mortgage insurance, if you're going to pay at one time, that is also going to show up in prepaid. So if people are opting to pay monthly, then these will look higher. So it's literally one of those things that, again, it's going to be whatever it is. And this is not something to compare if you're getting a good deal with this lender or this lender. Okay. Next, this section is really important. So we're coming back up to the lender fee section, but we're talking about points and origination. So points and discount fees, or origination fees and discount points, are the same thing. Okay. They do the same thing. They buy that interest rate down. So sometimes people will say, oh, I got a better rate over here. And what they really did was they bought their rate down. So their closing fees are a little bit higher, but they got a better rate. And that's fine. We can give you whatever rate you want for a price. It just depends on what's important to you. Right now, I am not a huge proponent of paying a ton of origination or discount points because interest rates have gone up so much that I know everybody is having people pay these. And some people are having people pay multiple points to make their interest rate look lower. However, I believe that based on what's happening in our economy, based on historical data, we might be going into a recession in the next 2 years. If we go into a recession, do not panic. It does not mean that the housing prices are going to go down. In fact, quite the contrary. Out of our last 10 recessions, there's only been one where housing has gone down, and that was 2008, and that's because we caused it. But in general, appreciation levels go like this through a recession. But what does move down are interest rates. So if I truly think that in the next year or two, we very well could have better interest rates ahead of us, I don't want to charge people a whole bunch of upfront money because it will not be utilized. Because the longer you have that mortgage, the better interest rate, or the more important the rate matters. But the longer you have it, the more then you have to work through the costs that you paid. And sometimes if I'm going to flip a loan in 2 years, those upfront costs will not have broke even, if that makes sense. If you guys have any questions, let me know. But that is a real challenge sometimes when clients are looking at things. So I did a example where I pulled, oopsies, get this out of the way, where I did my own little kind of review. So I put in a 5% down, first time home buyer, and I did it with Wells Fargo, US Bank, and Rocket Mortgage. I also put in a credit score of 740. So when I got back what my interest rate would be, and this was like a week ago, so please note rates are more now. This was from Rocket Mortgage. I put in that I wanted 5% down. I got 20% down. In fact, just a titch more than that. I was paying almost 2 points to get a rate of 4.5. Okay, so not at all what I put in, because of 20% down will look different for an interest rate than 5% down. Here's what US Bank kicked back. And I did this the same day, literally within a 15-minute window. Here's their interest rate and their APR. I do not know what kind of fee is in there. I'm thinking it's about 0.25%, but I wouldn't know. And this one says you have to have a 740 credit score. I put in Wells Fargo. Wells Fargo also has an interest rate of 4.5, but I don't quite know what it is. I got to go to the fine print. And here's where it says this rate assumes a credit score of 740, fine, includes 5/8 of a point in discount, and assumes we'll have an escrow account. But here's the other thing. It assumes 25% down. Again, I requested 5% down. So the reason that I show this to you guys is because even when I'm requesting certain things, they're giving me things back, and every single one of them are different. And even for me, if sometimes I'm like, I got to read the fine print, they're all different. How do I know which is the best? It's hard to know. So that's why I talk about this stuff, because everybody shows something different all the time. All right. Down payment options. Down payment options. So for conventional financing, conventional means we're doing loan amount 647,200 or less. We have 3% down. However, you do have to be a first-time home buyer to do that, or you have to be within the income limits of 83,440 or less. You also can do down payment assistance. There's MHFA and Dakota County bond. Again, up to 15,000, but income limits will vary based on household size. And so anytime you're doing any of these bond programs, there are different income requirements. If you want to have the payments be deferred, meaning no payment, otherwise the down payment assistance, you actually have a payment on it to pay it back. So there are lots of different things to look at for those, but they're definitely out there. Non-conforming, if you're looking at a larger home, 647,200 loan amount or higher, you can do 10% down up to $1.5 million, 15% down up to 2 million, and really anything over 2 million, you need 20% down. VA, 0 down. USDA, 0 down. FHA, 3.5% down. If you are a physician, we can do 0 down up to 750, 5% up down, up to 1 million, 10% down up to 1 million. This also works physician loan, dentists, veterinarians as well. All right, questions so far on any of this? I can't really see, there's nothing in the chat. So again, feel free to unmute and stop me if you guys have questions. All right, here is the biggest challenge that we have right now, list versus asking price. So house is listed at 330, but in order to win the offer, we've heard it 1,000 times, you've got to offer more. So what is normal? We see lots of variances on this, and it really comes down to what is the property priced at out of the gate? Is it priced a little bit below market so that they generate this frenzy, which I think is crazy, but whatever works? Or is it priced right where it should be? Or is it priced a little bit too high and they're just trying to reach for the stars? So that sometimes will give us that variance of how much people are over. We hear lots of times where, oh my gosh, it sold for $100,000 over. Okay, if you are getting that much over, and let's say you're at a $700,000 purchase price, I guarantee you priced it too low. Because if you would have priced it accurately, it would have never gone over that much. So sometimes we've got really creative marketing out there, and that's where your agent and the advice and what they're telling you, this is what we think this home is really valued at. I've done the research, I've done the comparables. This is what we think it is looking like, and this is where we think it could appraise. So these are just some of the ranges. Sometimes we see as much as 2% all the way up to 30% over. I think someone put something in the chat, so I'll ask. With mortgage interest rates almost double what they were in February, does pre-approval amount we get quoted in February still hold given the increased cost, month, dues, interest, etc.? Here's what I would say. Yes and no. So February, you're probably close. Everyone that was approved January and before with us, we're relooking at. And the reason is because when we pre-approve you, we will pre-approve you for usually about a point over market. So if you were pre-approved in February where interest rates were maybe mid to upper threes, we would have pre-approved you using an interest rate at mid to upper fours. So now that we are kind of there, or even tipping our toe into low fives, mid fives sometimes, depending on credit score, we should probably relook at that, because in general, 1% increase in interest rate will usually reduce about 10% of your buying power. So if you were approved at 300, we might be looking at 275, 280 at this point. It very much depends. The other thing that we are doing a lot of review with is, okay, now that the payments are X, those are $200, $300 more than what you want. What else can we look at to maybe free up other debt or pay off other debt or adjust other debt to make that payment feel more comfortable or more palatable for you? So we're spending lots of time doing that. So Nathan, if you want us to relook, which just I think better safe than sorry, just shoot me an email and we'll jump on a video or call for 15 minutes and review that just to make sure we're still in the right range or to make sure if there's anything else we should be doing. Okay. Am I overpaying if I offer more than the list price? Will I be underwater down the road? So this is something that we will, okay, you're welcome. So this is something that we do for clients. And guys, we, as much as I just don't love it, this is not a 9-to-5 job. I wish that it was. But there are lots of questions that we answer on the weekend. Now, do I want to answer like, hey, will you give me 7 estimates all varying by $1,000? No. But if you're like, hey, Lisa, we need your help, this is something that we can do on a specific property. And so this is called bid over ask. And I would say it works about 80% of the time. The reason I say 80% of the time is because it's not always as good if there's been a lot of remodeling or a lot of improvements on a property, or if it's been held for a long, super long period of time. But if there's been, you know, it's sold within the last 3 to 4 years, and in general, they kind of did cosmetic stuff, it's usually pretty accurate. And so what this does is it looks at the current asking price, how, and this is a real scenario, just so you guys know, how much that person thinks that they need to offer over the asking price to win, 425, so 45 grand over, estimated current market value, amount seller paid for home way back in 2009, and basically the break even. And what that means in break even is average appreciation that we are expecting in the next year and up to the next 5 years. You are basically biting into that appreciation. So how much appreciation are you biting into? And that's what that break even means. So basically it says if the current value is 387,600, but you paid 425 in 2 years or 26 months, that's about where that appreciation level would be at 425 anyway. And then after that, you're good. And then 5-year forecasted appreciation on this home would be about 70,000. So again, they're taking historical averages. So they're basically averaging about 3.78% appreciation a year conservatively. So again, this is something that we can do on a property. And like I said, it works about 80% of the time, but sometimes it gives people that peace of mind or that comfort that, okay, as long as I'm here for at least 2 years, probably in this case, 3 years, I'll be good. Okay. This is another way that we will look at this. So this is, if some of you have been pre-approved with us, Nathan, I know you have, you've probably seen this or I've reviewed it. So if I feel like the bid over ask isn't quite working, we'll pull this up and I'll say, okay, right now, if you're going to buy it for X and it's listed at 300 and that's where we think the value is, and you got to buy it for 320, let's look at about 4.68% appreciation is what's estimated to be for the next year. And then over the next 5 years, about 18%. So let's just assume maybe it's 4% this year or 4.6 and maybe another 4% the next year. So if you're buying that house, we would estimate in 2 years that it's probably going to be up about 8.6%. So about 2 years, if you paid 326, you would break even. If you paid 315, less than 2 years. In fact, probably a year and 6 months. So that's how we kind of talk through, does this make sense sometimes to pay over what you're paying? Okay. And we can do this on a specific property, or we can do it in a zip code too, this particular example. This is just one for Hennepin County. The previous one was Ramsey, but all of them change. And the data that I use for this is updated the first Monday of every single month. So usually it's pretty fresh. All right, appraisal gap. Appraisal gap comes up a lot because when you have an appraisal and a purchase price, our financing starts on whatever is lower. That's what we're going to base and start our financing on. So in this example, 300 appraisal, 300 purchase price, 5% down, loan amounts 285. Perfect. In my next one, if I have a 280 appraisal and a 300K purchase price with 5% down, loan amount now goes to 266. So now there's a gap between what we were willing to finance and your down payment and what is required to meet the purchase price. So I did a couple of examples just to show you options, because this is for my 3% down people. This is your challenge right here, because the only option that you've got is dollar for dollar. So what I showed people here was 5% down at a 320 sale price. So if you can see 5% down, 320 sale price, a normal loan payment, $21.28, cash out of your pocket, $28.95. That's normal. If I come back here, 320 sale price with 5% down, but my appraisal came in 20 grand short, and I'm going to cover it dollar for dollar. My payment goes down because I'm borrowing less money, but my cash to close goes up because I have to cover all of that. Okay. So previously it was $28,954. Now it jumps up to $47,700. That's a huge chunk of change. So in this scenario, really the only option that we've got potentially is looking at, instead of having 5%, we go 3%, because now we're financing just a little bit more. So here, payment goes up a little bit because I'm loaning you more. Cash to close goes down from my previous example, but still more cash needed than the normal example of 5% down, where the purchase price and the appraisal were one and the same. Okay. So all of my 5% people, definitely my 3% people, this is your nemesis. This is your challenge. Okay. Here's just a little bit easier way to do it. So life does get a little bit better if you do 10% down to cover any appraisal gap. So here, 330, 10% down, appraised value 330, loan amount, payment, MI, cash to close. That's normal. Okay. Now in this scenario, my appraisal came in 30 grand short. So now if you opt to pay dollar for this, look how high my cash goes. Okay. This one, purchase price 330. Now, if I go 5% down, 300 appraised value. Now I can lend you this. This is how things change. So my cash to close goes down, but is still a little bit higher than if everything worked out perfectly, but much less than if you opted to keep that 10% equity position and pay dollar for dollar. All right, so the biggest thing is, the reason that I show you this stuff is because I want you to know that you have options. Some of them are not pristine options, but they are options. If you have 15 or 20% down, the options get a lot greater. 3 and 5%, it's tough, super tough. 10%, more options open up. Okay. All right. I'm going to open it up for questions just to see if you guys have any questions on what I showed you. Anything else that you want me to talk about or reference or talk through or anything along those lines? I'm very popular today. Nothing? No questions? I just
What
spit
are,
a lot of junk at you guys. I'm surprised.
what are you guys currently doing for the interest rates today? I know it changes like every hour, but
Well, let's see. Let me show you. I'll share my screen again. Hang on, I'll get there. Bear with me. You'll see, and then I'll see too, because I haven't looked at anything. I just get beeps on my phone every hour about what's happening. So, oh gosh, come on.
and I think maybe if you could describe, like, I think this morning one of the headlines was, interest rates are now above 6 or 7%. And I know that really depends on your credit score and yada, yada, yada. But how should I be interpreting those headline numbers
So
without bugging you every day about what you're doing?
Nathan, do you get the, did you ever sign into HomeBot as a, that we sent you?
I did.
It's where you can go in and you can search for properties and that kind of thing.
Yes.
Okay, in there, they will update interest rates as well. So you can definitely look in there. I do updates every Friday to realtors, but I don't do it to clients. Maybe, I don't know, maybe I'll do that. It's just sometimes it's hard if it's not quite in their realm. But
Yeah.
so this is a good day. We very rarely have seen this lately. So what this means is we're up 39 basis points. So that means that's a good thing. US 10-year treasury is down. That's a good thing. So this is where we are today. This chart is interest rate movement every single day. Okay. So this is where we are today. This is where we were yesterday. This is where we were April 13th, March 31st, March 2nd. The higher we are in the chart, the better the interest rate is. Okay. So you can see we have been on a horrific playground slide for since February 2nd. We took a little breather here, but then really since March 2nd, we got a little bit better, but down we went again. So you asked me where interest rates were. If you have above a 740 credit score, if you have 5% down on a conventional loan, you are probably looking at low fives. And again, here's the other thing that matters: origination, no origination. So in general, right now, I'm quoting with no origination, and then we'll tell clients what one origination is. So you can probably get to 4.99 with one origination or one discount. Same thing. No, they are not 6%. No, but someone said, I listen to a lot of crazy people, but I did hear something this morning that the New York Fed does a review or kind of a survey with their constituents. And that came out, and that data said that their constituents believe, so these are just John Q. Public, believe that interest rates will keep going up, that they probably will get to 7% sometime this year, that they will potentially get to 8% next year, and that their confidence level of the Fed fighting inflation is like Zipola. So that is a very doom and gloom report. So if you're hearing anything on the news, it might be keying something like that, but keep in mind that sometimes the news is meant to alarming stats or alarming headlines. And I have not seen 6% unless your credit score is like 640 and you're trying to do a conventional loan or an investment property or second home.
Okay.
So yeah. And if you hear something like that, ask me, because that would like put me in a panic.
Yeah. And that's why I RSVP'd this morning, because I was like, well, today just happens to be the day she's doing her seminar. So.
Yes. Yeah. So again, what I would tell everyone right now that is buying or thinking about buying, or maybe thinking like, oh shoot, we were going to buy, but now interest rates are X. I know it sounds crazy, but if it were me, I would buy through the interest rate market. And I know I have a vested interest, obviously, in you buying, because it's how I put food on my family's table. But I have been through the dot-com bubble. I've been through 9/11. I've been through the Great Recession of 2008. I've been through COVID. I promise you that interest rates at this level do not stay. They are temporary. So if you can stomach it for the next year or two, there are definitely better days ahead for interest rates. And as home prices go like this, why not try to do both? Meaning, if you can buy a home, stomach the rate for or payment for a year or two, and then if we go through a recession, which, you know, 80, I think the calcs are about 80%, then take advantage of those lower interest rates, get yourself a lower payment. But now, you know, that home is appreciated and you get that appreciation versus paying it. So that's just kind of been my 2 cents.
So when you say take advantage after during the recession, that would be a refinance. Is that what you mean? Okay.
Yep.
Okay.
Yep.
I think our biggest struggle now is just I watched the homes that we offered on, you know, now 45 days ago, and they're finally closing. And so I can see that, you know, they're all sold for more than 50,000 over. And I think our big struggle is the appraisal gap that you had described. And that's just, that just is what it is.
Yeah. I mean, it's just so challenging, but the one thing that I would say is whatever property you're looking at, like really remind me who your agent is again, Nate. So,
Beth Richardson.
Have Beth look at, like, Beth, what do you think this house could comp out for, or what? And sometimes she's like, look, comps might support X. And then let's look at it, because I mean, knock on wood, we do anywhere from 15 to 25 purchases every single month. And we literally have had 3 low appraisals. 2 of them were on condos, which has a much more limited scope. And the other one was on a duplex, which also has more limited scope. So,
okay, that's good to know.
I mean, I can only give you stats because every property is so individual. Remind me what you were offering at, like what price point was it, like 3-ish?
Yep, we were just breaking the 3 mark.
So, and they were listed at how much? 290, 300?
Yeah, 275. One was in the low 230s, but that sold for, I think, 285.
Okay.
So that would be, I don't know, to me, that seems like crazy that somebody would, I don't know.
But, so that's about a 20%.
Yep.
Right? So depending on where you are, you know, if we ran that zip code thing, or we ran that bid over ask. So if you're in Ramsey County, that's going to take you about 2.5 years to make up. That's where the appreciation level is caught up to where you paid. But if you're in Hennepin County, I mean, it's, well, actually, let me go back. Sorry, I miscalculated. It's probably closer to 4 years based on that appreciation level. So 20%, actually maybe 5 years. If you're in Ramsey County, if you're in Hennepin County, almost 5 years too.
Yeah.
So that's where the hard part comes in, where was it priced a little bit low? Did comp support maybe 10 or 15 grand more? I don't know.
Right.
That's the hard part. And that's where Beth, you know, you got to ask that question of Beth or of me. I'll do my best, but I'm not Beth for sure in that world. But I've got data that I can say, well, this is what I'm seeing. But yeah, so it's so hard to say.
It is. And it does kind of feel just like a big, I don't want to use the word gamble because I get what you're saying, but it's a lot of time for an unknown return to, you know, find a house right now.
Yeah. And when you say unknown return, what does that mean?
Just the time we put into going and touring and then losing time after time. So not financial per se, but more the what my life has become as we try to win. So
I know this is stressful. Honestly, I've lived through a lot of markets. 2008 was probably a little bit stressful just because companies were folding right and left. I worked at Wells Fargo at that time. I didn't know, every day we woke up and we're like, are we going to keep doing mortgages or not? So that was more stressful on top of just this part. But this is a really stressful market for people too, because you don't know, and you put so much time, energy, and emotion into making the offers, and like a home is a home, right? And so then to lose out time and time again is super challenging.
Yes. Yeah.
And while you're watching it get more expensive too. I get it.
Exactly. Yes.
Get it.
So anyway,
But
thank you. This has been good.
Are there any other questions or anything else that I can answer from anyone else, or thoughts on anything else? One thing I will tell you, honestly, the headlines, they're headlines for a reason. And usually there's data that kind of can support, but it's how they spin it to get the deadline or to get the headlines. So if you ever see something where you're like, oh my gosh, I'm really alarmed about this, or I'm really nervous about this, just email or shoot me a message, because I spend probably at least an hour a day looking at articles, researching, reviewing, listening. So I feel like we're fairly up to date on things and can kind of read through, but we want you to understand and get the real story and not be scared because of a headline, because the news wanted you to watch it. All right, guys, if there is anything else that I can do for you or any other questions that come up, please let me know. We try to do these once a month just to get data out to people or information or frequently asked questions that our clients have. So we'll do another one in May. I'm not exactly sure what the topic will be yet, but we will figure it out. And if you guys have other friends or other people that are thinking about buying that think this would be beneficial, invite them or share the invite when you guys get it, because that's how we kind of grow this. And I just feel like this information is super important because we live this every single day. Okay. All right. Thanks for jumping on, guys. Have a good rest of the day. Okay.
Thank you.
Thanks, Lisa.
Got it. See you later.